Hey investors, thank you so much for joining me. My name is Michael from Deep Value Returns on Seeking Alpha. Today I want to talk about Peloton. So Peloton just reported their results. They pre-announced their results anyway, but they kind of gave you the shareholder letter. They talked about their guidance, and yeah, I mean, the past several days there's been so much news flow, and Peloton's stock has soared 50%. However, as we go through, I make the case that you should really just avoid this name. And I'm going to talk about different aspects here, but mainly, this is a cash incinerator, and I make the case that it's probably going to need to raise more capital, and it will have to dilute its shareholders, and there's just so many reasons here not to get involved. Yeah, hope you found this useful. So let's get into it. So as I already alluded to in the introduction, the share price has really soared the last 2 days, 50%. And it's a bit like Hertz. I don't know if you guys followed Hertz story. I mean, like, yeah, these things kind of the market sometimes a bit kind of goes a bit haywire. But anyway, so even if the stock is up last several days, there's really nothing really worthwhile here investing. And I just kind of think about it, right? So there was the news that Amazon was gonna acquire Peloton, and it was really anyone with deep pockets. I always like this, and Apple's gonna buy it. And like, I mean, as a seasoned investor, I mean, there is really nothing worthwhile paying 12 billion market cap for Peloton. Okay, so they've highlighted their guidance, and we can see here that the Q3 22. So remember, the fiscal year and the calendar year misaligned. So I'm just going to talk about the fiscal year. They talked about the guidance for Q3. Q3 was always going to be quite a heavy one. Guidance for Q3 negative 21%. And obviously guidance for Q4 negative 2%. So let's say they're kind of trying to lowball to kind of impress everyone, and it's just a business that they had a moment, and this is kind of coming to terms. So it's kind of interesting. I like listening to the earnings call, and the difference in the earnings call, the shareholder letter is quite stark. So the shareholder letter is like a coming to terms. The earnings call was a piece of work, and if anyone of anyone is listening to this, I mean, that was really just brilliant. Really strong earnings call. As if I was a stakeholder there, I'll be like, yeah, you guys doing a good job there. So they're talking about that they're gonna regain their footing, but and they're talking about how they're gonna be working really hard to kind of contain a lot of this, so that over the next several quarters everything's gonna be fine. But I think it's gonna take more than a few quarters to really kind of right this ship. Um, and I know that there's like ultimately what you have to contend with is not only is that Peloton's demand is falling, but anyone with a bike and a subscription already is on Peloton, and anyone that's not, the marginal late adopter, is not really the kind of thesis that you want to build on as a growth company. Okay, because growth companies get growth multiples, mature businesses get mature multiples. Okay, now it's been a real wild journey for Peloton, so and they're kind of like saying, okay, it's a new era for us, and yes, we were a bright star, but now we're kind of going to be involved in severance and restructuring. Okay, so that does a lot for key talent. Key talent at the top of the company. If you are a bright star, public markets are just in adulation of you. It's really easy to not only get key talent, but to importantly retain key talent. But Peloton saying, okay, we're gonna have to lose 20% of our corporate position. So that's gonna be a dynamic shift. Okay, they're also talking about they're gonna lose approximately 2,800 global positions. Now that does something for the culture of the company. When it's like a thriving environment and it's a growth company, everyone's very motivated, and then it kind of like everyone's getting fired. You're like, okay, what am I hanging around here for? Now, before I discuss its valuation, I just wanted to kind of highlight a few more things here. Okay, so I titled this "Path to Profitability is a Mirage" because they are saying that this year they're gonna have negative 600 million of EBITDA. Now, that EBITDA figure is going to be heavily massaged. Anything and everything will be added back to bolster up that EBITDA figure. So you have a company that's going to grow its revenues approximately 3.8 billion, 600 million of negative EBITDA. Now, I looked through the cash flow statement and they've burned through in the ballpark of 1.2 billion so far in the 6 months um, of this year. So, and they're talking about heavy restructuring and having to take a lot of cash restructuring, and they're going to try and be as aggressive as possible this year. So they're probably going to burn through 2 billion of free cash flow this year. So you make 4 billion, you burn 2 billion. I mean, it doesn't make a lot of good economics. But if you look at its balance sheet, it carries approximately 1.6 billion of cash and cash equivalents. Okay, now this is not a deal breaker, but you also have to consider they have approximately 1 billion of their 2026 convertible notes. So it's yet another thing. I was looking for this. So they have approximately 500 million on the revolver undrawn. So it's just mathematically there's no way that this business cannot, you don't wait until all the cash is gone from the business to raise capital. You need to raise it right now, and this is a good time to raise because share price has rallied quite significantly. But yeah, so if you raise capital, it means that the market cap is going to expand even further. So it means your return as a shareholder is going to compress even further. Because if you're paying a very high multiple for the company, ultimately it just depends on the intrinsic value of the business. But if the intrinsic value of the business is growing quite slowly, then if you pay too high a multiple, it's going to take too long for you to kind of be rewarded. Now, here's a few things. So Peloton right now is priced at approximately 3 times sales. Okay, the figures here are slightly wrong because the analysts were previously expecting higher revenues for this year. So, but anyway, it's kind of if you do the maths, it's kind of close to 3 times sales. So if you look back in the past year, the stock was priced at one point at approximately 10 times forward sales. So I know the pitch quite well, right? So it was priced at 10 times forward sales. Now it's priced at 3 times forward sales. It's clearly a bargain. But there isn't. There just simply is not. And I've been in this situation so many times that I've learned the hard way that even if it looks just down, there was the iHound quote that I put in the article that it's something like, twice a silly price is just silly, down 50% is not deep value. And it really is that, there's just so little value here. It's like, if you have a business that is maturing, you would expect to see the bottom line be quite strong, robust. You want to see high conversion from net earnings to cash flows. But not only you're not seeing that, it's just that it's going to be so long until there's actually a cash flow generating business in Peloton. And it's one of those things like it's it's a Peter Lynch one. Why everyone kind of likes the bike and it's so exciting to be on the bike, and you buy the stock because you know the bike and it's one of those few times that the Peter Lynch argument doesn't work out because you're familiar with the business, but the stock is just not worthwhile investing. And I think I made the case that this is just a dead cat bounce, and that given that the market has been so undiscerning of late and just selling off so many really great companies, highly innovative companies, I think it's difficult to make the case to pay 12 billion for Peloton. And just the summary of this is that I know that it's I know the thesis quite well. It's down 17% from its highs. It has to be a bargain. It has to be a quick trade. But I make the case that there is no free lunch. I think that it's going to be difficult for shareholders. But anyway, on a positive note, if you want to find out what kind of names I'm compelled about, don't forget to check out my marketplace called Deep Value Returns. Come on board, check out the reviews from my marketplace, and hope to see you soon, and good luck for the earnings season. Whatever you decide to do here, good luck and happy investing. See you soon. Bye-bye.